Welcome to the deep dive. Let's jump right in. There's something pretty interesting happening in the markets right now. You look at the big indices. S&P 500 down, what, about 18% this year? Nasdaq's taken a real beating, well into bear territory since early April.
Yeah, it's been rough.
But then there's this one company, Dollar General. Their stock is actually up 16% over the same time.
Quite a contrast.
Exactly. And it gets even weirder, or maybe more curious, when you think about President Trump's proposed tariff increases hanging over everything.
Right. That adds another layer of uncertainty for most companies.
So our goal today really is to try and figure out why Dollar General seems, well, so resilient. How are they weathering these economic headwinds?
Good question. And to really get into that, we're going to lean heavily on an article from the Motley Fool. It just came out April 12th, 2025.
Okay.
And the title kind of says it all. This recession-resistant stock is up 16% this year. Here's why it can beat Trump's tariffs. So that's our main source for this deep dive.
Perfect. A good starting point. It really does stand out, doesn't it? I think the article mentioned that just last week, pretty much every stock in the S&P 500 was down.
Yeah, most were in the red.
But Dollar General was one of the few exceptions. Them and, like, some healthcare companies mostly.
Right, which tells you there might be something specific going on there, not just broad market luck.
Yeah. Okay, so let's get into it. Why are they swimming against this tide?
Well, the first big idea is this concept of Dollar General being countercyclical.
Meaning they do well when the economy doesn't.
Essentially, yeah. That 16% stock jump this year is striking enough, but like you said, compare it to the S&P dropping 18%.
Huge difference.
And what's really fascinating, and the article highlights this, is how the market reacted right after Trump's tariff plans were announced.
What happened?
Dollar General's stock actually went up nearly 5% the next day.
Wow. So news that should theoretically hurt import-reliant retailers actually helped them.
It suggests the market thinks they're pretty well insulated, that they can handle potential tariffs better than others.
So it's not just strong performance overall. Investors seem specifically confident about the tariff issue for Dollar General. The article calls them recession-resilient, too. That sounds like they have a history here.
They definitely do, and a big piece of why they might beat these tariffs comes down to what they sell.
Okay. What's the breakdown?
In 2024, something like 82% of their sales were consumable goods.
82%. So mostly things people use up and buy again quickly.
Exactly. Think paper towels, cleaning supplies, packaged food, perishables, health and beauty stuff. The essentials.
Right. The things you kind of have to buy, good times or bad. Right. So how does focusing on essentials help specifically with tariffs?
Okay. Here's the key link. A lot of what they sell, especially the food items, is produced domestically, right here in the U.S.
Okay.
So that means they have much lower exposure to import tariffs compared to, say, retailers selling more discretionary goods, which are often imported.
So they're less reliant on stuff coming in from overseas.
Precisely. Citigroup analysts, according to the article, estimate only about 10% of Dollar General's inventory might get hit by these tariffs.
Only 10%. How does that compare to others?
Well, compare that to a competitor like Dollar Tree. The estimate there is closer to 50%.
50. Wow. Okay, 10 versus 50% that's a massive difference.
It really is. Dollar Tree sells more of those, non-essential items, toys, decorations, things that are more likely to be imported. Dollar General's focus on food and necessities, often sourced domestically, gives them a huge advantage on the tariff front.
That makes a lot of sense.
Yeah.
So their core product mix naturally shields them quite a bit.
Exactly right. Fewer imported goods means fewer goods subject to those potential extra taxes.
The article also talked about their track record during past recessions, didn't it? You mentioned recession-resilient earlier.
Yes, absolutely. Yeah. And the numbers are pretty telling. If you look back at the Great Financial Crisis, 2008, 2009, Dollar General's same-store sales, that's a key metric, sale at stores open at least a year, jumped 9% in 2008.
9% during that crisis.
And then another 9.5% in 2009.
Incredible, when everyone else was struggling.
It really underlines that recession-resilient label. And what's maybe even more remarkable is they've had positive same-store sales growth pretty much every single year since 1990.
Every year? Really?
With just one exception, which was 2021.
Okay. And wasn't that right after the huge surge in 2020 from, pandemic pantry loading?
Exactly. People stocked up like crazy in 2020, so 2021 saw a bit of a dip from that massive high. But even that negative year had a very clear, unusual reason behind it.
So the overall pattern is undeniable. When times get tough economically, Dollar General tends to hold up or even thrive.
That's the historical trend. The article explains it simply. Consumers trade down.
Meaning they switch to cheaper options.
Yep. When budgets get tight, people actively look for ways to save money, and discount stores like Dollar General become much more attractive.
Makes intuitive sense. Get more bang for your buck.
Totally. And another, maybe less obvious advantage they have is selling things in smaller package sizes.
Oh, interesting. How does that help?
Well, think about it. If money's tight, maybe you can't afford or don't want to buy a huge 12-pack of paper towels from Walmart or Costco.
Right. You just need one roll to get you through the week.
Exactly. And Dollar General lets you do that. You can buy a single roll of toilet paper, a smaller bottle of detergent. It's easier on the cash flow week to week.
That's actually a really smart point. It caters directly to that budget-conscious shopper who might be buying more frequently, but in smaller amounts.
That flexibility is key, especially during downturns.
Okay, so history shows they navigate storms well.
Yeah.
But the article wasn't all positive, right? It mentions some recent struggles.
That's right. It's important to have that balance. They haven't been totally immune to recent pressures. The article notes they've actually lost a bit of market share, particularly to bigger competitors like Walmart.
Okay. Why is that?
And their profit margins have also been squeezed. Inflation seems to be hitting their core customers, typically lower-income households, particularly hard.
So even their target demographic is feeling the pinch, which flows back to Dollar General's bottom line.
Exactly. Higher costs and strained consumers created some headwinds for them recently.
So what are they doing about it? How are they trying to, get back on track?
They've rolled out this strategy they're calling back to basics.
Back to basics. Sounds straightforward. What does it involve?
It's focused on a few key things. One is making the supply chain more efficient. They're actually closing some temporary storage locations they'd opened up.
Okay. Streamlining operations.
Another big part is improving the actual store experience. Trying to reduce out of stocks, making sure shelves are full.
Which can be frustrating for shoppers.
Definitely. And ensuring they have enough people working the checkouts so you're not waiting forever. Basic blocking and tackling, really.
Makes sense. Getting the fundamentals right. Anything else?
Yeah, they're also still investing in remodeling older stores and continuing to open new ones, even while focusing on these operational improvements.
So a mix of fixing the existing issues and still planning for growth. Seems like a solid plan. Are there any signs it's starting to work?
Well, their 2024 numbers showed same-store sales grew 1.4%.
Okay, so positive growth, even if it's modest.
Right. It suggests demand is still there, maybe even picking up a bit, despite those margin pressures we talked about.
And what about looking ahead? What are they forecasting?
For this year, 2025, their guidance is for same-store sales growth somewhere between 1.2% and 2.2%.
So they're continuing that modest positive trend.
Yes. And importantly, they're projecting a rebound in earnings per share. They're aiming for $5.10 to $5.80, which is up from $5.11 last year in 2024.
Okay, so they expect profitability to improve. It sounds like they feel they're turning a corner, perhaps.
That seems to be the message. They're stabilizing, implementing fixes, and, maybe ironically, the current economic uncertainty could actually work in their favor again.
Like a tailwind, as the article might say.
Exactly. If recession fears keep growing, that historical pattern of consumers trading down could give them a significant boost just when they're getting their operations back in shape.
Interesting timing.
Yeah.
What about from an investment angle? Did the article touch on valuation? Is the stock considered expensive now after being up 16%?
It did touch on that. It mentioned the price-to-earnings ratio, the PE ratio, is currently around 17.
And is that high or low?
The article suggested that's well-priced, meaning not excessively expensive given their performance and prospects, kind of in a reasonable range.
Okay.
It also pointed out the dividend yield, which is about 2.6% right now. That can be attractive for certain investors looking for income.
So not screamingly cheap, but reasonably valued with a decent dividend.
That's the gist.
Yeah.
Overall, the takeaway from the Motley Fool piece is pretty positive. It paints Dollar General as a sturdy stock, one that seems well-equipped to handle potential economic storms and maybe even outperform if the economy does weaken further.
Okay, so let's try to wrap this up then. The core idea is Dollar General sells essential stuff, lots of it made domestically, which shields them from tariffs more than many others.
Sure.
Historically, they do well when the economy tanks because people hunt for value and appreciate smaller package sizes.
Check again. They benefit from that trade-down effect.
And while they've had some recent issues with competition and margins,
Yeah, the back to basics strategy.
right, their back-to-basics plan seems to be stabilizing things, and the current shaky economic outlook might actually become a positive driver for them.
That sums it up pretty well. Their whole business model seems uniquely suited perhaps to navigate the kind of uncertainty we're facing right now. Makes them stand out in a market where most things are down.
Yeah, it really does. This has been a fascinating look at why one company might be thriving when so many others are struggling. Really highlights how different business strategies react differently to the same big picture economic forces.
It absolutely does, and it leaves us with something to think about, doesn't it? How do these shifts in consumer behavior during downturns ripple through different sectors? Are there other companies out there with similar traits, maybe that focus on value or essentials or a low import reliance, that might also be showing this kind of resilience?
Good question. Looking beyond the obvious names.
Yeah, and thinking beyond just the stock price, too. What other signs, what other indicators could tell you a company is built to withstand pressure? It's worth considering what signals underlying strength, especially when times feel uncertain.